In the summer of 1982, a small bank in Oklahoma City failed. Not a Wall Street institution, not a century-old financial giant. A bank operating out of a shopping mall, run by a man who threw legendary parties, handed out loans like business cards, and believed the oil boom would never end. The failure of Penn Square Bank sent shockwaves through the American financial system that nobody saw coming, and ultimately triggered the largest bank bailout in U.S. history up to that point. To understand Penn Square, you have to understand the oil boom that made it possible. Through the late 1970s and into the early 1980s, oil prices were soaring. Oklahoma was at the center of an energy rush, and money was flowing into the state faster than anyone knew what to do with it. Wildcatters, independent oil and gas drillers, were borrowing enormous sums to fund new wells, betting that prices would keep climbing. Banks were falling over themselves to lend to anyone with an oil lease and a handshake. Penn Square Bank sat in the middle of this frenzy. Founded in the 1960s as a modest consumer bank in a shopping center, it was transformed in the late 1970s under the influence of a charismatic energy lending officer named Bill Patterson. Patterson was everything a buttoned-up banker wasn't. He drank beer from a boot. He dressed up in costumes at company parties. He handed out loans to oil and gas borrowers with almost no meaningful due diligence, based largely on personal relationships, optimistic projections, and an unshakable belief that oil prices had nowhere to go but up. Under his influence, Penn Square's loan book exploded. A bank that had no business writing nine-figure energy loans was doing exactly that, and growing at a pace that should have raised every red flag imaginable. But here's where Penn Square's story becomes something much bigger than one reckless small bank in Oklahoma. Penn Square had figured out a way to extend its reach far beyond its actual size. It was selling loan participations to much larger banks across the country. In simple terms, Penn Square would originate a loan, write the deal, collect the fees, and then sell pieces of that loan off to bigger banks who wanted exposure to the booming energy sector without having to originate the deals themselves. It was a way for Penn Square to keep generating fees while passing the actual risk off to others, and the others were buying eagerly. The most significant of these partners was Continental Illinois National Bank and Trust, based in Chicago. At the time, Continental Illinois was one of the largest banks in the United States. At its peak, the seventh largest in the country by assets. Continental Illinois had made a strategic decision to aggressively grow its commercial loan portfolio, and energy lending looked enormously attractive. Through its relationship with Penn Square, Continental Illinois purchased roughly $1 billion in loan participations, energy loans that Penn Square had originated but were now sitting on Continental's books. Other major institutions, including Chase Manhattan, Seattle First National Bank, and Michigan National Bank, also purchased significant participations. The problem, which became apparent with terrifying speed once oil prices started falling in 1981 and 1982, was that a huge proportion of these loans were essentially worthless. Penn Square's underwriting had been a fiction. Borrowers had been approved based on inflated collateral valuations, rosy production projections that never materialized, and in some cases, outright falsified documentation. When oil prices dropped and the Oklahoma energy boom turned to bust, the borrowers couldn't repay. The loans went bad in enormous numbers, and suddenly, every institution that had purchased Penn Square participations was sitting on massive losses. Penn Square Bank failed on July 5, 1982. The FDIC made the unusual decision not to arrange a traditional bailout or acquisition. Instead, they simply closed the bank and paid off insured depositors, leaving uninsured depositors and creditors to absorb losses. It was a stark, brutal resolution that sent an immediate message through the banking system. Penn Square's counterparties were on their own. The fallout was immediate. Seattle First National Bank, which had purchased around $400 million in Penn Square participations, was effectively destroyed. It was acquired by Bank of America in a rescue deal. Michigan National Bank took severe losses. Chase Manhattan wrote off significant exposure. But the most consequential casualty was Continental Illinois. Continental Illinois didn't fail immediately after Penn Square, but the Penn Square losses, combined with other troubled loans in its portfolio, left the bank deeply weakened. In May 1984, almost 2 years after Penn Square's collapse, Continental Illinois experienced something that had rarely been seen in American banking before: a run. Not a traditional run, with depositors lining up outside branches. Continental Illinois had very few retail branches. Instead, it was a wholesale run, with large institutional depositors and creditors, other banks, corporations, foreign institutions, pulling their money electronically, billions of dollars moving out of the bank in days. The bank's funding base evaporated almost overnight. The federal government faced a stark choice: let Continental Illinois fail, which would potentially bring down dozens of other banks that had lent to it or deposited with it, or intervene. The scale of potential contagion was genuinely terrifying to regulators. Continental Illinois had $40 billion in assets and was intertwined with banks across the country and around the world. The FDIC, the Federal Reserve, and the Treasury Department coordinated an unprecedented rescue. The FDIC effectively took over Continental Illinois, injecting $4.5 billion directly and arranging total support that ultimately reached somewhere between $8 billion and $13 billion when all facilities were counted. The government became the bank's majority shareholder. It was, at the time, the largest bank bailout in American history. The Continental Illinois rescue gave birth to a phrase that would echo through American financial policy for decades: too big to fail. A comptroller of the currency, testifying before Congress in the aftermath, essentially confirmed that certain banks were simply too large and too interconnected to be allowed to collapse, that the government would step in regardless of the cost to taxpayers. It was a doctrine that would shape banking regulation and banking risk-taking for the next 40 years. When you hear "too big to fail" in the context of 2008, the concept was born in the wreckage of a strip mall bank in Oklahoma City. Bill Patterson, the architect of Penn Square's lending madness, was convicted of misapplication of bank funds and received an 18-month prison sentence. Other Penn Square officers faced criminal charges as well, but the sentences were light relative to the scale of the damage, a pattern that would repeat itself in financial crises for decades to come. The lessons of Penn Square were documented, analyzed, and ultimately not learned. The same dynamics: aggressive origination, risk passed off through participations and securitization, regulatory oversight that failed to keep pace with innovation, and an unshakable belief that a particular asset class could only go up, reappeared in the savings and loan crisis of the late 1980s, in the dot-com era, and most catastrophically, in the mortgage crisis of 2008. Each time, the mechanisms were slightly different. The underlying human behavior was identical. Penn Square Bank occupied a few thousand square feet in an Oklahoma City shopping mall. It had no business reshaping American financial history, but it did, because it found a way to export its recklessness to institutions large enough to threaten the entire system, and because the regulators and bankers who should have stopped it were either looking the other way or too eager for the fees to ask uncomfortable questions. The shopping mall is still there. The bank is long gone. And the doctrine it accidentally helped create, that some institutions are simply too connected to be allowed to fail, is still shaping how governments around the world respond to financial crises today.